Hi, and welcome to our Inside Insurance M&A Valuation and Deal Structure webinar. This is our second webinar in the three-part series on insurance M&A that's been coming out throughout this year. I'm your host today, Matt Staninger, Market Research Analyst here at Oak Street Funding. And today I'm joined again by Chris Hughes, Managing Director of Insurance Distribution at M&A Services. Today we'll be covering valuation methodology, value and deal structure, tax consideration, and probably much more. Chris, thanks again for being here today.
Looking forward to this second of our three-part series here. First time we covered M&A process. Today we're going to talk a little bit about how to value an insurance agency and what some of the deal structures look like. And then later this year, I think we're going to put on one on once you reach a letter of intent, a valuation, and a deal, what does the due diligence and contracting process look like and what are some of the hurdles there? So happy to be here to talk about all things insurance agency valuation.
Sounds good. Well, to start things off, Chris, one of the key documents that's oftentimes is necessary for an agency valuation is a pro forma income statement. Can you explain to us what really is a pro forma income statement?
Yeah, I sure can. Insurance distribution firms, whether those are retail agencies, wholesale agencies, management companies or risk retention groups or RRGs, any kind of firm that sells the insurance product, those types of businesses are sold off of a multiple of pro forma EBITDA. EBITDA being earnings before interest, taxes, depreciation, and amortization. And to get to a pro forma EBITDA number, the very first step is to start with your actual income statement and then to normalize that or make pro forma adjustments to that income statement to make it look like, what a normalized run rate corporate firm looks like, not a privately held business. And to do that, you start with your actual income statement, and then you make pro forma adjustments. And you make those adjustments to create that corporate-looking income statement, the pro forma. And you do that by making adjustments to a market salary or market compensation for the owner, market compensation for your producers. You either add or eliminate, excess or redundant staffing. You make adjustments for any extraordinary or one-time non-recurring income or expense items. You take out all personal expenses. So a lot of times in a privately held agency, what you'll see is, the owners might have their spouse or children running through the payroll and running through for health benefits. You might have personal autos or personal cell phones running through the expense structure. Things that are personal to the owner. So you adjust those things out to arrive at a pro forma income statement. You take if it's a property and casualty agency, sometimes you see one-time big commissions for the sale of a life insurance policy or the sale of an annuity, but that's really not normal course. Those are one-time non-recurring commissions, so you might adjust those out. You might have one-time expenses. A good example would be a big server expense. Maybe you spend $100,000 creating servers for your company that you're not going to have running through your expense structure year over year. It's kind of a one-time thing. You take those one-time non-recurring expenses out, and then you take out all of the definitional things to EBITDA: interest income, interest expense, income taxes, not payroll taxes, because payroll taxes are part of a normalized expense structure, but income taxes, and then depreciation and amortization. And you see, depreciation a lot of times when an agency has acquired other agencies, they're able to depreciate that. So you see that on the income statement, quite frequently. You adjust all of those items out to create your pro forma income statement, and then you'll have a pro forma net income, taking out extraordinary, one-time non-recurring items as well as interest income. And then you have your pro forma expense structure that makes all of those adjustments to a market salary, a market rent, any kind of excess or redundant staffing. You create your pro forma. At the bottom is the pro forma EBITDA number. And to value an agency, you apply an appropriate multiple to that your pro forma EBITDA number, and that gives you the base valuation for an insurance agency. And that's the methodology used and what a pro forma income statement is.
That's a great in-depth description of what a pro forma looks like. And of course, with lending, we deal with that a lot of times as we're trying to look at the projections as well. And I know when you talk about normalizing something, everyone might have a slightly different view on what that normal is. So, in your experience, how do buyers tend to react to an optimistic versus maybe more of a conservative projection in these pro forma income statements? We see both here. Certainly, I've seen both while I've been here. Some may value it more of a pie in the sky sort of situation. Some may want to go more conservative. What's your experience been on how buyers react on those two different normalizations?
Sure. So, in terms of a time period, when you're looking to value your insurance agency, the most relevant time period is the trailing 12 months. So, as we're sitting here today, you would look from August 1st, 2024 through July 31st of 2025, and you would run your actual income statement. You'd make those pro forma adjustments. And then if you're going to raise capital, whether that's debt or equity or sell all or a portion of your business, most capital providers are going to want to see 3 years of historical financials, and you'd make those similar pro forma adjustments to your maybe 2022, 2023, 2024 full year numbers, your trailing 12 months numbers, which is where your base valuation is coming from, and you'd have a full year 25 projection, and then you'd run that out for one more year for 2026. And when you're doing pro forma adjustments, and whether you're being aggressive or conservative, I think realistic is the very best way to be with whatever capital provider it is, whether it's debt or equity. So once you have, your historic 3 years and your projection for this year and for next year, I think what matters is it's realistic. And if you're looking at like growth rates and, historically you've grown at a 10%, compounded annual growth rate for the last 3 years, and all of a sudden you're like, hey, we're going to grow at 90% this year and 90% the following year, you better have a lot of information, a lot of initiatives, and a lot of momentum toward getting that. Otherwise, any lender or any equity capital provider is going to look at it and say, hey, that's not realistic, and it's going to damage your credibility. So by being realistic, and also I would say, you want to be optimistic, but you want to have some facts to back up that optimism, right? If you're like, hey, normally we've grown at 5% organically, but we're entering this hard market in this specific product line, and this is where 80% of our business. So just with that, we're going to get 10% growth on rate alone this year, next year, right? You might build in a more optimistic growth projection.
Right. I think the key there is being, as you said, reasonable there, being realistic with what those projections are. We may see some that are a little bit over optimistic, but again, if you have the data and those insights to provide why it might be more optimistic or why growth may be a lot higher. So when you're normalizing that, you can look over and find trends maybe over the last 3 years, as you suggested, and see what that actually looks like. But to get to that point, if a business owner wants to start and increase the value of their business, can you walk us through some of the top valuation drivers that impact an agency in today's market? Of course, this would be something they would want to look at prior to being in the thick of things, but they want to make these adjustments ahead of time. What are those, at least some of those top valuation drivers that you see moving the numbers?
Sure. So in getting ready to go to market and thinking about whether you want to sell your agency, whether it's this year, 3 years from now, or 5 years from now, some of the top valuation drivers, some of the things that make an agency more valuable rather than less valuable are, I would say the very key one is growth, right? And you have organic growth, which everyone's keyed in on. All the publicly traded companies are, in the mid-single digit organic growth rate right now. So you're privately held and you're showing double digit or better, organic growth rates. That's huge. Inorganic growth or growth through acquisitions can also be helpful, but that organic growth metric and thinking of how am I going to grow my agency, more than 10% a year for the next, 2 or 3 years, that's super important. That will have buyers value your agency more than others. The size and the scale of your operation. So if you're at, say, 1 million EBITDA, trying to get to that $2 million mark, that's a big driver of valuation. Having a good bench strength. So depending on what your agency looks like, being a one-man show is kind of a big deal, and having a bench and some talent underneath you. So either you're a part of a team or you're stepping away, as long as there's a good bench underneath you, and that can be producers, that can be key executives, but having a strong bench in place prior to the transaction, that increases the value. It's also another key driver of value, but a key kind of risk component of this is looking at client concentration, producer concentration, and carrier concentration, and trying to mitigate those risks. And the more that you have a good story for each one of those risks, those can increase the value of your business as well. So those are kind of, I would say the top three things are growth, the key bench, and the size, scale, and risk mitigation factors that you have in place. And as you think about those things, what does my business look like today? What's it going to look like in 12 months, 36 months, and 60 months out?
Those are great insights. All three are really key areas, but especially when you talk about the carrier concentration, some of these other things that may be impacting the ultimate value of the agency in today's current market environment. What are you seeing impact valuations and deal activity today? Of course, there's all kinds of different things that impact this industry, whether it be carriers, renewal rates, natural disasters. I mean, there are tons and tons of things that ultimately could impact the valuation. But what are you seeing currently impacting valuations and deals that are at the highest level?
Sure. So one, the size and the scale of an operation matters, I think, a whole lot. So insurance agencies that are between, say, $500,000 in EBITDA and $2 million in EBITDA, in general, those firms will trade at somewhere between an 8 and a 10 times multiple of EBITDA. Once you get to kind of a scale of $2 to $5 million in EBITDA, you'll attract double-digit multiples. So those multiples of EBITDA will be somewhere between 10 and, say, a 12 and a half times multiple. And then once you get to a platform size investment of greater than $5 million of EBITDA, you'll attract private equity, pure play private equity. You'll be a platform for very large agencies, and those multiples can be anywhere from, say, 12 and a half to 14 and a half times. I think you run into a ceiling on scale at that 14.5 times multiple of EBITDA. I mean, we've had a number of firms, Aon's transaction with NFP last year, Brown & Brown's acquisition of Risk Strategies this year, and Marsh closing out acquiring McGriff. All of those were, between 8 and, say, call it $14 billion transactions, and they traded at 14 to 15 times EBITDA, right? So that's kind of the ceiling of as high as you're going to get. In terms of trends that are impacting valuations, we had, a period of time from, say, call it 2013 to about 2019, where there were anywhere from 4 to 550 deals a year transacting. So we had pretty high valuations. It was very much so a seller's market then. Then COVID hit. There was a little bit of a pause in the market, and there was a ton of capital from the federal government that flowed into the marketplace. So that there was maybe a quarter of a pause, 3 months of a pause where not a lot of transactions were happening in the first quarter of 2020. But for the remainder of the year, as the capital from the federal government started flowing, and as the industry looked and said, hey, if we're not in the restaurant business, or if we're not insuring, all of our business isn't insurance or cruise lines, the insurance distribution industry wasn't really impacted by COVID, and a lot of private equity and a lot of capital flowed to transactions. And in 2020, 2021, and 2022, we had a record number of transactions in those years from all of those federal dollars flown in. Along with all that capital that flowed into the marketplace, you saw this huge inflation number tick up, and then not far after that, you saw interest rates spike. So what we thought was going to happen is that spike in interest rates was going to have a downward pressure on valuations, but we didn't really see that at all. We saw different players, some of the more highly leveraged players like PCF Insurance and Aquasure, maybe take a pause, maybe prioritize their transactions a little bit more. But then you saw the publicly traded brokers come in and just like pick up the slack where others had fallen off. And then interest rates come down from like 9% to, where they sit right now, for the low fours, and maybe even looking to go a little bit lower here in the next half of this year. I think everyone's digested the current interest rate environment, and we're not seeing much downward pressure at all on valuations. So I think we're kind of in a Goldilocks sweet space with interest rates, capital and buyers' appetite. I think we're in a great place for it being a seller's market right now with interest rates. So I think this is where the market's at. I don't think that that's going to change for the foreseeable, 6 months going into the remainder of this year, or really looking forward into 2026. In addition, just like to mention, they just passed a tax bill. A lot of times when you have a new administration, there's a lot of worry, hey, our capital gains rate's going to change, either positively or negatively. And
Right.
sometimes that can create either a lull or, hey, we need to sell, by the end of this year.
Yeah, there are a lot of really good points there, especially early in the decade, whenever we saw that there was a big push before capital gains concerns were coming around. I think that was 2021. And combine that with the fears that interest rates were going to be going up pretty soon after that, when inflation was first rising, as you had mentioned. There were a record number of deals transacting all of a sudden. So it's not just on the valuation side, it's on the tax implication side where sellers may decide it's time for me to sell, and that just makes sense by the numbers. And that could be a certain mover in the market as well, that we've seen over the years here at Oak Street.
Yeah, generally it's with the new administration and what are they going to do? And you see this big either spike in the fourth quarter and then the lull the following first quarter.
We're talking a lot about valuations. Of course, the seller's trying to maximize their value all the time. What are some of the most effective ways a seller can maximize value through their deal structure?
Well, when we're talking about deal structure, let me just tell you, here are the main components of a deal structure. There's closing consideration, cash and equivalents. There's buyer's equity. So a lot of firms will trade, will pay 75% cash at closing, and 25% of the consideration will be in the buyer's equity. Some firms allow you to retain equity in your own firm with a predetermined multiple and exit time period going out. So there's seller's equity. And in every deal I see, there's some kind of earn-out component. I don't see it so much, but sometimes you'll see a seller financing component to deals. But the biggest thing that a seller can do in terms of maximizing value in their deal structure is, A, when you're looking at closing consideration, if you're a $1 million EBITDA agency and you're trading at a 10 times multiple, if you can change your multiple from a 10 to 11, your closing multiple, right? If you can run a process and get multiple buyers looking at your agency, and instead of getting a 10, you get an 11, you can increase the value of your agency by, say, 10%. And not to tout, my own horn, but having an investment banker that can really look at pro forma EBITDA adjustments and come up with what's market out there, because we deal with every buyer out there, right? We know what's acceptable and what's not acceptable. So instead of being a $1 million EBITDA shop, if you create a $1.1 million EBITDA shop, you can keep the multiple the same and also create that extra 10% of value, and just knowing what the market would accept in a pro forma income statement. So you can change your closing consideration, either multiple or your pro forma. Second, you can look to invest in the buyer's equity or retain your own equity and structure a deal where you're getting paid a high multiple on a future EBITDA number. Or most of these buyers, whether it's World Insurance or High Street or Alkeem, all of these, aggregators out there, they'll allow you to invest in their equity. And generally they're showing somewhere between a 25% and 35%, compounded annual growth rate. And if you model that out for 3 years, you can make it an investment, tax deferred investment into their equity and then exit that 3 years out. So structuring your deal and picking your investment, whether it's your own equity, retaining a portion of your own equity or invested in a buyer's equity, that's a key deal structure that you'll want to consider. And then lastly, and I think most importantly, is maximizing growth through your earnout period. And in general, most earnout periods are a period of 2 or 3 years. And you can get a multiple of any growth that goes on there. So if you can grow your agency at, say, 10 to 20% for the next 3 years, you can maximize your earnout and generate another 25 or 30% of deal value in your earnout. So those, I think, are the 3 deal structuring components that a seller can maximize to maximize the overall value of the deal. And if you can hit on all 3 of them, I don't want to say you can double the value of your deal, but you can significantly increase the value of your deal by maximizing your EBITDA multiple paid, maximizing the pro forma income statement and coming up with a realistic normalized pro forma, making strategic either investments in retained equity or the buyer's equity, and then maximizing growth through your earnout.
Great points, especially talking about those earnouts being so common. And really, from a lender perspective, we like to see the owner stay active post-sale for a period of time as well. If you look at when an agency owner might not quite be ready to sell yet, but is thinking forward and they're doing their preparations, saying, I'm not ready to step away now, but maybe over the next 2 or 3 years, I might be ready. How should a business owner who's looking to sell over those next 2 or 3 or even 4 years help prepare themselves to mitigate any risk that may be associated with waiting time, as opposed to selling right now?
So there's a couple of things that I want to unpack there. So the first thing is, sure, an agency owner can decide to sell their business this year. It's a 6-month process. And if they're looking to retire and step away, I think they'll be doing themselves a disservice by saying that. A lot of buyers would like to see some kind of continuation, a transition period over a period of 1, 2, or 3 years to have the owner involved, to have a little bit of skin in the game, and to say,
Sure.
hey, I'm in a business that's stable and that the owner is going to be, engaged in. So just think about that as one thing. And then in terms of mitigating risk, earlier I'd mentioned the 3 biggest risk factors that I see most buyers concerned with are client concentration risk, producer concentration risk, and carrier concentration risk. The carrier concentration risk comes into play mostly with MGAs, where there's like 1 carrier per program, and there might only be 1 program or 2 programs. So if that carrier went away, that's a huge risk to the business in the MGA world, right? And you can mitigate that risk by really focusing on the underwriting and the loss ratios. So even if you're a retail agency and you don't have that many carriers, if you can say, hey, my book of business is such and such size, I have this big of a premium base with this carrier, and it's a profitable book of business, this is what our loss ratio looks like. So even if that carrier decided, hey, I don't want to be in a specific state in this line of business, it would be easy to transpose and put that to another carrier. That mitigates your carrier concentration risk. So thinking about your carrier concentration, your underwriting in your business there. For your producer concentration risk, making sure that your producers have, good non-competes, non-solicits in place, but just as importantly, that they're happy, right? That they're happy with their commission structure and that they're incentivized to grow and go out and find new business. And whether that's through bonus programs, you want them to have a market rate, but you want to have them incentivized to go out and get new business. So most buyers we have a bifurcated, hey, we pay 40% for new business and say 30 or 35% for renewal business. It just incentivizes growth and going to find new business. So that kind of focuses on producer concentration risk. And then lastly, you have client concentration risk. So if you have any one client that makes up more than, say, 20 or 30% of the book of business, having multiple product lines into that client And if you're looking, 1, 3, or 5 years out, you're saying, hey, I have one client that makes up 20% of my business. I need to figure out how am I going to diversify that client base, right? I'm either going to have to go find some new clients to diversify that, or I'm going to have to put in some new products into that client, some new hooks into that large client. Maybe you have a multi-year contract with that client. Um, Things like that, just so that you can be aware of and cognizant of what that client concentration risk looks like and dealing with that. So those are the three things. And then just again mentioning having an owner that's going to be engaged, after day one of a transaction is important as well.
Right. From our perspective, we look at all those things, and managing risk, of course, is a part of being a lender. So we like to see that diversification. Buyers typically like to see that diversification as well. And really seeing that warm handoff, as we had talked about, with the owner staying on board and helping with the transaction post close, is also very helpful. We mitigate the risk associated with concentration, whether it be by carriers you had talked about or by an individual account holder. So lots of risks are going to be associated with that, especially if one is holding a significant portion of that. But there are ways to work around that and mitigate, just as you had mentioned. We talked earlier about some of those drivers that move deals, and some of that may be about around tax considerations. So what are some of those tax considerations that both buyers and sellers should be keeping in mind as they pursue a deal?
So most insurance agency transactions are asset purchases rather than stock purchases or equity purchases. So in a stock sale, there's an asset purchase agreement versus a stock purchase agreement. And the reason that buyers like to buy assets are when they're buying the assets of an insurance agency, almost all of those assets are intangible goodwill assets. There's not a lot of, property, fixtures, equipment, inventory in an insurance agency. It's really that client list, those client relationships. It's the goodwill of that business. And a buyer's able to amortize that goodwill over a 15-year period. So there's a real financial benefit, tax benefit from the buyer's standpoint to be able to amortize that over 15 years. And from the seller's standpoint, in a pass-through entity, an S corporation or a LLC or a limited liability partnership, right? Any kind of those pass-through entities, the sale of the asset triggers long-term capital gains. So that's the lowest tax rate for a seller. The thing that I think you want to be aware of is if you're a seller or thinking about being a seller, now or in the future, and you're structured as a C corporation, it's very difficult for you to do an asset deal. And the reason for that is it would be the C corporation that's selling the assets. And in a $10 million deal, just to give easy round numbers, a $10 million deal, the C corporation sells the assets. The C corporation is taxed at 21%, so they have $7.9 million left to distribute. When they distribute that $7.9 million down to the shareholder then has to pay taxes on that 7.9, and it creates a double taxation event. So you want to avoid that. And if you're a C corporation, especially a small business as a C corporation, you might want to talk to your tax advisor about becoming an S corporation. And you can't flip the switch immediately and get all the advantages of that. It takes a 5-year period to convert from a C corporation to an S corporation and wait out that 5-year period before you can avoid the full effect of that double taxation. So that would be one key thing. Not that there's not ways to mitigate double taxation. You can look to allocate some portion of it as personal goodwill. You can look to do a stock purchase, but most buyers are wary about that because there's no step up in basis for an amortization of that goodwill. And you're also on the hook for all obligations, known and unknown, if you do a stock purchase versus, an asset purchase of the deal. So talking to a tax advisor, and really if you're a C corporation, really thinking about transitioning to a pass-through entity now in anticipation of a sale 5 or 7 or 10 years from now.
In all reality, I feel like it's pretty rare that I see any C Corp agencies in this space that I'm dealing with or that we deal with here. Certainly, it seems like the vast majority are either going to be S Corps, LLCs, or LLPs. at least taxed more like an S Corp. Is that what you found in your experience as well?
It is. I would say, probably 80 or 85% of all of our deals are S corporations or LLCs. And the 10 or 15% of deals that aren't and that are C corporations, they've been around for a while. It's not something they thought about, 20 or 30 years ago when they founded the agency. They weren't thinking, hey, I need to be a pass-through entity to sell my agency 30 years from now. We've had to implement some of those strategies through either a stock sale or through the purchase of personal goodwill.
So, summing it up, there are a lot of factors to look at from a historical and from a pro forma basis. If you're thinking of getting toward that selling point in the future, what are some of the key things that you would consider?
Yeah. So again, I would come back to some of those risks and I would just make sure that you're focusing on having a bench behind you so you're not selling a one-man show. Two, looking at your client concentration risk and how can I, anticipate that over the coming years. Looking at your producer contracts and your carrier contracts. For your producers, are there good non-solicits, non-competes in place? Am I making sure my key producers are happy with their compensation structure and incentivizing growth there? Are my carrier contracts, is my business flowing to the right carrier and producing the underwriting results for that carrier that they're looking for? So just looking at those types of things. And then I don't really think that you have to worry a whole lot about interest rates and taxes, at least in 25 and 26, but you do want to be cognizant of interest rates and taxes as you look, over longer periods of time. And then I think the third trend that you would look for is what your business looks like in terms of a rate environment. Are you entering a hard, soft, or stable market? And what's the outlook of that look like for the next, foreseeable 6, 12, 36 months? I mean, the Florida auto market is in a softening market. You have the California property market in a hardening market. You have, general liability, casualty markets, kind of commercial lines, in a little bit of a softening market. So it really depends on your market for your business and what does that rate environment look like now? Because that impacts organic growth rates. That's one of the most, key factors that buyers are looking for in an acquisition.
Right. We see time and time again, organic growth is one of those key factors. Chris, again, thank you. It's always valuable and great insights that you provide. So thanks for being here today and sharing those insights with our audience. We appreciate everyone's continued viewership. Stay tuned for more from us here at Oak Street as we look for the third webinar in our series with Inside Insurance M&A, which should be coming sometime in November. So Chris, thanks again, and thanks to everyone watching.